Altria Group stands as a high-yield constituent within the consumer defensive sector, offering a forward dividend yield of approximately 6.36% as of early 2026. As a dividend king with 56 years of consecutive increases, the company's institutional identity is inextricably linked to its cash return policy. Financial performance and 2026 guidance. Altria reported robust full-year 2025 results, delivering an adjusted diluted EPS of $5.42. For the 2026 fiscal year, management has provided guidance for adjusted diluted EPS in the range of $5.56 to $5.72, representing a growth rate of 2.5% to 5.5%. This growth is anchored by the performance of leading brands such as Marlboro, Copenhagen, and Black & Mild, alongside the rapid expansion of the oral nicotine portfolio.
The company maintains a progressive dividend goal, targeting mid-single-digit annual growth in dividends per share through 2028. In 2025, the dividend was increased by 3.9%, marking the 60th increase in the company's history. This commitment is supported by an adjusted operating company's income (OCI) margin of 62.4% in 2025, with management targeting at least 60% annually through 2028. Altria Group metrics, February 2026. Cash dividend payout ratio, TTM, 75.23%. Sector median, 59.61%. Net long debt/EBITDA, TTM, 2x, meeting management's long-term target. Interest coverage, TTM, 11.40x. Sector median, 6.07x. Adjusted OCI margin, 62.4%. Management strategic target, greater than 60%. The safety of Altria's dividend is fortified by its robust balance sheet and disciplined capital allocation. The company achieved its target debt to consolidated EBITDA ratio of 2x at the end of 2025. While the cash payout ratio of approximately 75% is higher than the sector median, it is consistent with Altria's historical 5-year average of 80.38% and appropriate for a mature, cash-generated business with limited capital expenditure requirements. The ability to grow earnings at a compound annual rate of 3.6% from a 2022 base, despite regulatory and volume headwinds, underscores the effectiveness of its pricing power and cost efficiency programs.
Enterprise Products Partners is characterized by its reliable business model in the midstream energy sector. The partnership provides a distribution yield of approximately 6.2% to 6.4% in early 2026 and holds a 27-year streak of annual increases. A significant catalyst for EPD in 2026 is the anticipated reduction in organic growth capital expenditures. After an intensive investment phase of $4.5 billion in 2025, the partnership expects CapEx to taper to approximately $2.5 billion in 2026. As major projects come online and the capital intensity of the business decreases, the partnership will have substantially more free cash flow available to fund its distribution and its expanded $5 billion share repurchase program. The fee-based nature of Enterprise's assets, which include 50,000 miles of pipelines and 250 million barrels of storage, provides insulation from the volatility of commodity prices. These assets generate stable cash flow by collecting fees based on the volumes of materials transported and stored, rather than the market price of the oil or gas itself.
Enterprise Products Partners safety and coverage. Distribution coverage ratio, 1.7x, providing a highly comfortable margin. Annual distribution growth streak, 27 years, representing every year since IPO. 2026 projected CapEx, $2.5 billion, down from $4.5 billion in 2025. Credit rating, investment grade, reflecting a strong focus on the balance sheet. Dividend risk score, B, signifying reasonable and better safety. Enterprise Products is at the conservative end of the energy risk spectrum. Its 1.7x distribution coverage is one of the highest in the midstream sector, meaning it generates 70% more cash than it pays out to unit holders. This excess cash is utilized to self-fund expansion projects, reducing the need for dilutive equity raises or expensive debt issuance in a high-rate environment. The partnership's investment-grade credit rating further confirms its financial stability, making it an ideal core holding for conservative income investors.
Ares Capital is the largest business development company in the United States,
providing investors with a high-yielding passive income stream of approximately 9.4% to 10.13% in February 2026. As a regulated BDC, Ares is required to distribute 90% of its taxable income to shareholders, a structure that naturally supports high yields. Ares Capital enters 2026 in an advantageous position as bank consolidation and failures have reduced the number of traditional lenders in the middle market. The company estimates a $3 trillion opportunity in traditional middle market lending and an additional $2.4 trillion in companies with over $1 billion in revenue. As of the end of 2025, Ares had $28.7 billion in total investments across 587 portfolio companies. The portfolio is defensively positioned, with 71% consisting of senior secured loans. Ares Capital dividend coverage and portfolio. Quarterly dividend, 48 cents, which has remained stable since late 2022. Core earnings per share, 50 cents, providing sufficient coverage of the quarterly payout. Spillover income, $1.26 per share, acting as a significant cushion for future payouts. Net income margin trailing 12 months, 42.56%, reflecting the company's high profitability.
The safety of Ares Capital's dividend is enhanced by its strategic cushion, the spillover taxable income carried forward from previous years. By carrying forward $1.26 per share, the company can maintain its quarterly 48-cent dividend even if it experiences a temporary decline in core earnings due to market volatility. Furthermore, its relationship with its parent, Ares Management, provides it with superior access to high-quality deal flow and capital markets. Energy Transfer offers one of the highest yields in the midstream segment, currently yielding approximately 7%. While its history is more volatile than enterprise products, the partnership has undergone a significant financial transformation since 2020. Energy Transfer's current yield is viewed by many on Wall Street as being on a rock-solid foundation following record results in late 2025. The partnership's decision to cut its distribution in half in 2020 was a strategic move to strengthen the balance sheet and self-fund growth. With that process complete, the distribution has been restored to levels above the pre-cut mark, and management is targeting an annual growth rate of 3% to 5%. To achieve this, Energy Transfer has planned capital investments of up to $5.5 billion in 2026. The partnership's scale is immense, and it has recently added fuel to its growth engine through strategic acquisitions and record operational throughput across its interstate and intrastate pipeline systems. Energy Transfer comparative metrics. Target distribution growth, 3.5%, similar to EPD over the long term. 2026 capital investment, $5.5 billion, focused on organic growth and throughput. Historical safety note. A distribution cut in 2020 occurred during the pandemic downturn to strengthen the balance sheet. The primary risk with Energy Transfer is its historical willingness to prioritize the balance sheet over distribution stability during severe downturns. Analysts suggest that while the yield is higher for a reason, the current cash generation is more than sufficient to cover the payout. However, the partnership is better suited for income investors who can tolerate more risk that may accompany broader energy sector volatility. Verizon Communications is a dominant player in the U.S. telecommunications market, offering a dividend yield of approximately 6.8% as of early 2026. The company's financial identity in 2026 is defined by its massive $20 billion acquisition of Frontier Communications, which closed on January 20, 2026. The acquisition of Frontier is viewed by S&P Global Ratings as integral to Verizon's current identity and future strategy. It allows Verizon to bundle high-speed home broadband and mobile services across a significantly wider footprint, enhancing its ability to compete with incumbent cable providers. This strategy is designed to reduce customer churn and increase the average revenue per account, providing more stable long-term cash flows.
Despite the capital intensity of the telecom business, Verizon's mobile and broadband segments generate substantial free cash flow. This money is used to expand and maintain its 5G network, pay its high-yielding dividend, and strengthen the balance sheet. Verizon Dividend Safety and Leverage, February 2026. Cash Payout Ratio, TTM, 57.05%. Sector median, 34.69%. Interest coverage, TTM, 4.73x. Sector median, 3.76x. Net long debt per EBITDA, TTM, 2.44x. FCF, net of dividends, approximately $8 billion projected for the 2026 fiscal year. Verizon has increased its dividend for 19 consecutive years, while the Frontier acquisition will modestly increase leverage to an estimated 2.8 to 3x in 2026. The company's liquidity profile remains strong, supported by $3.4 billion in cash and an expectation for $7.5 billion to $8 billion in free cash flow after all dividend payments are made. The stable outlook at both S&P and Moody's reflects confidence in Verizon's resilient business model and improving operating momentum.
Main Street Capital is known for its monthly dividend structure and consistent payment of supplemental quarterly dividends. The combined annualized yield for investors in early 2026 is approximately 7%. Main Street sets its monthly dividend at a level it can sustain even during severe economic downturns. Currently, the monthly rate is 26 cents per share, which has been raised by 4% over the past year and 136% since the IPO in 2007. The regular monthly dividend is covered 1.4x by distributable net investment income. To comply with IRS regulations regarding income distribution, Main Street utilizes supplemental quarterly dividends to return excess income to shareholders. For the past couple of years, this supplemental payment has consistently been around 30 cents per share each quarter. Main Street's primary safety mechanism is its lower middle market focus and its diversified portfolio of debt and equity investments in smaller private companies. Because the company often takes equity stakes in addition to debt, it benefits from capital appreciation that can fund the supplemental dividends. Main Street has a track record of never reducing its regular monthly dividend.
HP, ticker HPQ, represents an opportunity in the technology sector for income investors, offering a forward dividend yield of approximately 6.2% in 2026. In late 2025, HP raised its quarterly dividend by 3.7% to 30 cents per share, extending its growth streak to 15 years. While the company saw some operating margin decline in 2025, management remains confident in its cash generation capabilities. For the 2026 fiscal year, management forecasts free cash flow of approximately $2.8 billion. This provides more than enough capital to cover the dividend and continue the company's aggressive share repurchase programs. HP dividend coverage and value. Payout ratio, non-GAAP, 37.32%. Comparison, sector median is 35.11%. Interest coverage, TTM, 8.49x, indicating strong capacity for debt servicing. PE ratio, 7.34x, suggesting the stock is undervalued compared to the S&P 500. Free cash flow 2026 estimated at $2.8 billion, which is ample for ongoing distributions. HPQ's dividend safety grade is currently a B+, supported by a low payout ratio of approximately 37% and a manageable net debt to EBITDA ratio of 1.14x. The company has paid dividends without interruption since 1965. The stock offers a combination of high yield and value, as the market appears to be discounting the potential upside from the PC refresh cycle. Universal Corporation is the world's largest leaf tobacco exporter and importer, operating as the wholesale link between farmers and cigarette manufacturers. As a dividend king with 55 years of consecutive dividend increases, offering a yield of 6.1% to 6.2%. Universal is a global business-to-business agri-products company that has recently expanded into ingredients operations, providing plant-based ingredients for the food and beverage sectors. This diversification is intended to mitigate the long-term decline in global leaf tobacco demand. In February 2026, the board affirmed its quarterly dividend of 82 cents, signaling commitment to its shareholders, despite a pullback in earnings per share in fiscal 2025. Universal Corporation safety metrics. Dividend growth rate, 10-year, 4.7% for annual distributions. Payout ratio, earnings, 73%, suggesting potentially solid coverage. Net long debt divided by EBITDA, 1.87x, sector median, 1.74x. Interest coverage, TTM, 3.09x, which is lower than the sector average. While Simply Safe Dividends classifies Universal as borderline safe, the company's 55-year track record is one of the most consistent in the market. Analysts note that while earnings coverage is around 73%, cash flow coverage has historically been much higher, providing management with so much cash left over for reinvestment. The primary risk is the volatility in quarterly results due to weather-dependent agricultural cycles.
Blue Owl Capital is a rapidly growing alternative asset manager,
offering a current dividend yield of approximately 7.3%. The company operates in a similar space to Ares Capital, but focuses on the management side of the private credit and real estate markets. Blue Owl's revenue is largely derived from management fees on its permanent capital base, which provides highly predictable and recurring cash flow. Unlike BDCs that rely on interest payments, Blue Owl benefits from the volume of assets under management. In the 2026 environment, as institutional capital continues to rotate into private credit, Blue Owl is positioned to capture a significant portion of this inflow. Blue Owl's dividend safety is categorized as reasonable, with a risk score of C. The firm is aggressive in its payout and growth, but the high-margin nature of asset management, combined with the secular tailwinds of the private credit boom, supports the current yield.
MPLX is a master limited partnership formed by Marathon Petroleum Corporation, which owns 64% of the outstanding units. MPLX yields approximately 6.5% and has demonstrated aggressive dividend growth recently, including a 12.5% increase in the past year. The safety of MPLX's distribution is tied closely to its parent, Marathon Petroleum. S&P Global Ratings assigned a BBB rating to MPLX's proposed senior unsecured notes in February 2026, noting that MPC would support MPLX under most circumstances if it came under stress. The partnership is a vital component of MPC's logistics chain, operating infrastructure across every key U.S. supply basin. MPLX safety and debt metrics: net income margin TTM 41.57%, making it exceptionally profitable for its sector. Cash flow payout ratio 70.14%, indicating a well-covered distribution. Net long debt/EBITDA 3.67x, maintaining an investment-grade profile. MPLX maintains a strong liquidity position, utilizing new note offerings to repay debt due in March 2026. While its leverage of 3.67x is higher than the sector median, its interest coverage of 4.84x is 25% higher than the sector average, indicating robust capacity to service its debt and maintain its payout. The partnership's strategic relationship with MPC creates a floor for its credit quality and distribution reliability.
Conclusion: the shift toward higher-for-longer rates has disproportionately benefited BDCs like Ares Capital and Main Street Capital, whose floating-rate portfolios thrive as rates stay above historical norms. Simultaneously, the midstream energy companies, Enterprise Products and MPLX, provide a vital inflation hedge through fee-based contracts that prioritize volume and critical infrastructure over commodity price sensitivity. For investors prioritizing safety, Altria and HP offer the strongest fundamental coverage through high operating margins and conservative payout ratios, respectively. While Universal and Energy Transfer carry slightly more historical or agricultural volatility, their current cash flow trajectories and long-term commitment streaks make them high-probability sustainment candidates within a diversified portfolio. Ultimately, the sustainability of a dividend in 2026 depends on a company's ability to maintain its interest coverage and payout to cash flow ratios as older debt is refinanced into the current 3.5 to 3.75% rate environment.